Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Today, I'm thrilled to be joined by Clint Edgington, founder of Nest Opportunity Fund. Clint joins us today from Columbus, Ohio. Clint, it's great to see you. How you doing?
Great, man. As always, I'm thrilled when I get to talk to you, Jimmy.
Oh, that's too kind. Well, thanks for coming back on. Clint, you've been on a lot of my OZ Pitch Day events over the last few years. I don't know how many of them you've been on, maybe 4, 5, 6, 7, 8. It's hard to keep track now, but so a
Sounds
lot of
right.
my audience, high net worth investors, family offices, advisors, they may already be familiar with you and with Nest Opportunity Fund, having seen you on my platform, having seen you on OZ Pitch Day in the past. But for those who may be unfamiliar, can you tell us a little bit about yourself, your background, and what is Nest Opportunity Fund?
Sure. Nest Opportunity Fund is a opportunity zone fund. It was started with in 2019 when the final regs went in. That day we kind of opened up, been prepared for it, and we do small residential real estate in Columbus, Ohio, and Lexington, Kentucky. Heavy rehab. We usually take kind of the most burnt out houses on a certain block in an upcoming area, and we kind of basically rebuild them from the inside and then hold them and rent them. So going back as far as background goes, my parents bought their first small residential real estate property in 1990. So growing up, I mowed their yards and served my first eviction notice, I think, when I was 16. And so it's the mom and pop landlording is kind of in the blood. And we're still kind of in that space. So I for a while went out to Chicago, did some expert witness work for financial institutions. And then, at first I was just pushing spreadsheets around. But then continued kind of investing in smaller real estate with my family, and also a fellow in Lexington, Kentucky. And then we kind of had a capital gain in 2018. We had started an investment advisory firm, Beacon Hill, and we started our own OZ fund, and we called it a fund, but it was just the three of us, me, my mom, and Jeff in Lexington. And we've been funding his deals for a while. So we basically just started doing what we've been doing in the past. He already had about a couple hundred single families there that he had rehabbed, and they were in OZ census tracts, which we didn't know what that word meant at the time. And it was just kind of like, gosh, I have a cap gain and you have a cap gain, and we've got people who are doing this exact work in this exact neighborhood. Let's not pay the tax. So it started in 2018, and some of our investment advisory clients had an interest, but the initial language was kind of murky on multi-asset funds and raising capital for them. So we didn't launch until the final regs went through. So 2019 we launched, and now we're still a small fund. We're very kind of mom and pop-ish feeling. You see our marketing investor letters to our investors that we send. It's they see the sausage factory. It's not glittery. It's not glossy. But we do what we say we're going to do, and we kind of keep on plodding.
Oh, that's great. No, and it started because you and your family, your partner had this capital gain and had this need to defer it into projects that you were already working on that happened to be in opportunity zones. And then you saw a need from your RIA clients. They're like, hey, I want in on this. And now you're raising capital from new outside investors as well. I think that's why you like to join us on our OZ Pitch Day events. What would you say is your main approach to opportunity zones? You mentioned you're doing some developments in the Midwest, but can you unpack that a little bit more? What exactly is it that you're doing in your opportunity zone projects?
Yeah. Basically we purchase properties, so some single families, duplexes. Our largest is a small 31 unit, but mostly going to be duplexes, quads, 8 units. And we purchase usually pretty beat up properties, and we're going in. What we've seen is that to get that substantial improvement that's required for the OZ rules, generally speaking, we're replacing mechanicals. So once you replace mechanicals, you're kind of you're kind of replacing all the cosmetics in the envelope as well. So heavy rehab, which, creates operational, issues for sure. But also kind of decreases the pool of competing buyers, especially in Lexington. It's a little smaller than Columbus. So yeah, we work on that, and it takes a good amount of time. We buy them with cash, we rehab them with cash, and then once we're done, we'll go and we'll get financing and do it again.
That's great. And is it just in those two cities? Is it just in Columbus and Lexington where you're developing? And what do you like about that part of the country and those two cities in particular?
Yeah, just in Columbus and just in Lexington. I mean, the main thing that I like is that I'm in Columbus, and so I think real estate's a ground game where it's so easy to let costs start to move up on you, especially when you're not there or one of your partners isn't there. And in Lexington, we have the same thing where the guy who's doing the rehab work there, he's a partner in our GP, he's an investor in the LP. 20% of his fees being a GC gets reinvested as an LP. So we're kind of as aligned as I think we can be. But you got to be there. I mean, I think especially in times like this where you're not just going to get returns based on market multiples increasing. You kind of need to pay attention to the blocking and tackling.
Yeah, you got to pay attention to those costs. Those costs creep up. By
Yeah.
the way, an older former business partner of mine, he would use the saying, "Hey, you're gonna have people stealing from you if you don't have your eye on them." And I think he meant that kind of tongue in cheek. People stealing from you, right, Clint? Like they're not oftentimes literally stealing from you, but if you don't have your eye on everything and all the costs that are happening, boots on the ground, like you said, it's such a ground game. Like you're gonna let those costs soar up one way or another, just because your attention turns elsewhere. So I think
Yeah, and
that's
not even
right.
just not even stealing. I mean, for example, in Columbus, we hire folks who've graduated from some sort of addiction program for the
Mm-hmm.
actual rehab work. Um, and I was concerned about that at first, certainly. Um, but haven't had an issue, with that. I mean, we had some break-ins in some of our kind of properties because we are in kind of up and coming, but not there yet type
Mm-hmm.
neighborhoods. But also just like incentives are never completely aligned with different people doing different things.
Yep.
So you got to just be there, and like if they know that you're going to be there looking at things, then things move at a little different pace. Um, but not just us being in the areas. I mean, so we looked at anywhere within kind of a 5-hour drive of Columbus. And if you know the Midwest well, kind of if you draw a line from Chicago to Cleveland to Pittsburgh, there's kind of some rust belt there and like up north. When you start to go south in the cities, like Columbus is, the fastest growing large city in the Midwest. Lexington's is smaller; it's about a third the size, but they don't grow as fast because they have some kind of constraints on the city size. But the areas around it are growing at a pretty decent pace. And we've got kind of vibrant, diversified economies. So, even in Columbus, you kind of think the financial sector is usually like one of the riskier sectors. Well, ours is all insurance, like it's nationwide, all state, are all headquartered here. So, when you're in kind of the play of where you're going to be doing whatever you want to call it, like workforce level or maybe even some affordable housing, you want a good, stable, diversified employer mix. So Columbus and Lexington are never going to have the property price appreciation of Austin um, earlier this decade or San Francisco last decade, but we're also not going to have kind of the drops that they have as well. So it works for us.
Yeah, might not experience the same level of boom, but unlikely to experience a bust either. It seems like it's a fairly stable, conservative play if you go into your fund. Let me ask you, how is the fund structured? Is it just one big
But
fund that's
now,
investing?
Jimmy, stable is starting to get sexy.
It
Yeah, I
is.
mean, all the data centers want to come to Columbus because you open up the paper and we're never in it because we don't have fires or earthquakes or so Intel's chip development's moving here.
Mm-hmm.
So I don't know. Now that it's no longer boring, we might have to leave.
I never said the word boring. I think you used the word boring.
Oh,
It's
sorry. That was me.
stable. Stable is good.
Stable.
Sick of volatility? Try stable.
Yeah.
Try stability. Welcome to
Yeah.
Columbus. But getting back to my other question, how is an investment? How are the investments you make? Are they structured? Is it just one big nest opportunity fund, one qualified opportunity fund that invests in all of these different assets, or do you have different funds for each city or different funds for each asset, or how does it all work?
Yeah. As we're set up right now, we've got one opportunity zone fund, and then two series within that fund. So basically, we broke it up based on time frame, where folks who came in before, I think, May of 21 are in our Series A, and they have the economic rights and benefits to our Series A subsidiaries. So we have one subsidiary in Columbus that holds the Columbus assets, one in Lexington that holds the Lexington assets. We didn't capital raise for a while and didn't reopen the next series, I think, until end of 21. Just numbers were not penciling that well. And then those came in afterwards, were in the series, or in the Series B, which owns two different subsidiaries, Nest Columbus B and Nest Lexington B, which own different properties.
Got it.
But one bombed out house being rehabbed next to another one, they all look the same, both kind of financially and kind of when we're done with them.
Sure. No, understood. Well,
Yeah.
across that entire fund, both series, how many properties roughly do you currently have in your portfolio? What's the total project cost or value size as well? Just
Yeah.
trying to get a sense of the scale.
Yeah. So we've got about 75 properties. And don't quote me on this exact number. We're doing our partner letter right now. I should know it, but I've been looking at the details more than like zooming out. And probably like 110 units. So relatively small, I would say we've got kind of a good chunk of single families, and then probably relatively the same amount from an asset size perspective of multifamily, from a dollar amount, on the smaller side. So, in Lexington, we do more of the single families. And so that, we can purchase single families there relatively inexpensive, 50 grand. And, but there are going to be heavy rehab costs. So then, we'll get out the door at 150 a square foot there probably. And we think neighborhoods that are, doing pretty well. And we also kind of build them to a level that we want to hold them rather than just to sell them. So some things that don't like kind of instantly pay back, we spray foam our crawl spaces and have tankless hot water, those types of things, easy to maintain. Columbus, we are all multifamily. So each individual asset generally costs more here. So a duplex will be probably 200 that we buy, and we'll have 354 into it by the time we're done. And a lot of it depends on the we've got one monster of a duplex. It's a super cool brick. Also, I mean, some judge used to live in it or something. So we've got to be careful not to fall in love with it though. But we'll have more into that one. Versus we've got some literally properties that were burnt, which I think is what I walked folks through in the pitch day 2 times ago. It was a burnout, and so that will be less. I mean, because it's never going to be a $600,000 duplex.
No, that was a great walkthrough you did for our OZ Pitch Day Summer 2023 event. I'll make sure to link to that in the show notes for today's episode at opportunitydb.com/podcast. But yeah, Clint showed us the before picture. He actually did a walkthrough of one of these rather beat up properties that he had just acquired. There was some burn damage. It was torn down to the studs in I think in a lot of locations. And you took us down into the basement. You talked about the tankless. You took us upstairs. I think you talked about
Basement's
the
the first place you got to go.
What's that?
Like the basement's the first place you got to go.
You got to go to the basement. You got to see how much water damage there is, right?
Mechanicals, all the stuff. Yeah.
Yeah.
And the star of that show was Oscar.
That's right.
Working on
That's
it
right.
that day.
Oscar was the star of that show. I remember. Hey, what was I asking? Oh, the total value of your entire portfolio at current moment. Are you at about $10 million or more or less? It sounds like.
In net assets, about 10, and then kind of gross, we're at like about 15.
Got it. Good. Where are you finding value these days? I know it's a tougher market. Transaction volumes down. Are you still buying up as many properties this year in 23 as you had been in previous years? Where are you finding value?
Yeah, no, we've slowed our purchasing for sure. There's kind of a dichotomy right now, and a lot of times when real estate starts to slow, you know, like now, you see it first in transactions slowing. You don't necessarily see prices dropping as much, because would-be sellers kind of get used to what they think the price will be. Would-be buyers, their financing costs have increased and they're kind of repenciling their numbers, and there seems to be a gap for a while usually. And so we're not seeing a ton of transactional volume. And we're also not seeing, prices slide across the board. I'm not seeing distress. Certainly not in Columbus. But there are some pockets, and I would say, prior to this year, when people start talking about their pipeline, their acquisition pipeline, and it's proprietary. I don't know, maybe for other people, in Lexington, we're kind of one of only 3 groups that can take down a package of 5 houses that will do something that small, right? That's heavy rehab. And so I would say we maybe had the closest thing I've seen to actually kind of proprietary pipeline. But if we said no, they're calling one of the other 2 people.
Yeah.
But I am seeing a little bit now how kind of the certainty of close is starting to matter to folks. So if you've done deals and you've been doing them and you've closed, so that's something we talk about. During COVID, we had offers out there, in February, when we all kind of realized, oh wow, this is the thing, that we came through on, and a lot of folks kind of dropped all their offers at that point in time. So that certainty to close, I think, is starting to pay a little bit of dividends. But we're just seeing pockets of decent deals that have kind of reverted to the new world of, everyone's financing costs have gone up. So we have to think about that and not continue just buying away.
Good. Yeah. Well, understandable that transaction volume has slowed for you this year as well. Hey, let's talk tax cuts. You want to
So,
talk
but
tax
we're
cuts?
waiting because we're just at some point, one group is right and the other becomes kind of wrong. And
Yeah.
so, I mean, I don't see the downside to just kind of waiting and pouncing when potentially there's some distress.
Sure. And eventually you'll get those that price drop at some point coming
Maybe.
up here. Hopefully, if you're a buyer. Hopefully not if you're a seller, right? Depends which side of the equation you're on, I guess. Uh, but let's talk about tax cuts, Clint. Because before we came on, you said, "Hey, I want to talk about."
I want some.
Well, yeah, who doesn't like tax cuts? As you know, Clint, and as a lot of my audience knows, I'm sure, opportunity zones is a provision of the 2017 Tax Cuts and Jobs Act signed into law by President Trump. A lot of those TCJA provisions, these tax cuts, are actually expiring at the end of 2025. Some of the provisions are expiring at the end of 2026, including opportunity zones. As an investor, as a high net worth investor or a family office, someone who's tax conscious, in your mind, Clint, what should I keep my eye on? What should I be aware of, or what should I do with regards to knowing that a lot of these provisions in the TCJA are expiring here in the upcoming years? What are you advising your clients to do?
Yeah, so kind of the same, theme as, real estate operations, that it seems like it's maybe likely we're in a little bit of a lower return environment than we've been in or have been used to during a 30-year kind of interest rate decline. So kind of focusing on the basics, the blocking and tackling, I think makes some sense now. So picking up kind of non-market related returns if you can, like tax alpha, I think becomes a little bit more important. Assuming the Tax Cuts and Jobs Act tax brackets and structure is not extended, which I think that should be kind of the basis for it. And it's a bit of a heads you win, tails you don't lose by doing the planning now. So one thing that we're talking to folks about is Roth conversions. Now is the time to start thinking about that. We work with investors, and a lot of them they can fill up their, if they're a kind of medium income folks, they can fill up the 22% tax bracket, and we can show them like, listen, in 2 years, that's going to be, 33%. So go ahead and like fill that bracket out now and move your IRAs that you still owe taxes on into Roths. So you've got 2 years to do that.
So basically, pay the tax bill now at a lower rate, and then you've got after tax Roth assets as opposed to paying that tax bill down the road at a higher rate, right?
Yep.
So a little bit of a tax arbitrage strategy, and I love the way you put it, like heads you win, tails you don't lose, right?
Yeah, I
So a
mean,
little bit of tax
there
alpha
are
that
some
way. What
folks,
else? What else,
there
Clint?
are some potential folks who could potentially lose. If you're middle income folks and you're on the verge of retirement, your income's about to drop, maybe. But for the majority of people with relatively steady income before and after that sunset, it's not going to hurt you to go ahead and do that now, even if it doesn't expire. Another thing that I see a lot of folks think it's just for ultra high net worth is the estate tax minimization kind of techniques, which dovetails nicely in with opportunity zone funds as a private equity holding. The lifetime gift and estate tax exemption is set to sunset as well. So right now it's 27 million between you and a spouse that you can pass through your estate tax free, where it's going to drop, basically in half in the end of 2026. So, even if you're not worth 13 million, but you think that you're going to grow into it, now would be the time to kind of do some of that planning, because, you'll lose a good chunk of that opportunity as soon as the clock strikes 12. And, OZs are a great option for that estate tax minimization, putting them in the grantor trust. And there's a ton of ways to do it to kind of fully optimize it, but effectively you put normal asset into a trust like that, and you kind of freeze the value of it for the value of your estate at what it goes in at. And then the appreciation, will be taxed at capital gains for your heirs when they sell. Where the OZ kind of can blend it, where you get the freeze on the estate taxes, and then, assuming your heirs hold it for the entire period of time of 10 years, then they get the tax-free exit and depreciation recapture free. So that can be that I see being the right vehicle to fund one of those, which is generally long-term holding as well. So it makes some sense. Yeah, those are the kind of like the things that we're looking at and talking about with higher net worth investors.
That makes perfect sense to me. I mean, you mentioned earlier we're in a lower return environment right now. How do you find alpha? You can find alpha through higher returns, but that's no guarantee, especially these days. Asset values seem to be pulling back a little bit, but you can always work on controlling your costs. We talked about that earlier. You can get alpha out of that. And then you can also work on tax planning. You can get tax alpha. I love those two strategies, just that basic blocking and tackling. Clint, it's been a pleasure speaking with you today. We're kind of winding down our time here. Wanted to know, just zooming out, big picture, what you're seeing, what you're keeping an eye on in terms of trends in the broader private equity real estate landscape. What are you keeping an eye on?
Yeah, as far as broader real estate, I'm kind of keeping an eye on who's going to be right, buyers or kind of would-be sellers that are on the sideline as far as pricing goes. Of course, people are watching kind of the interest rates and whatnot, but at some point in time, transaction numbers will pick up. They have to. And it'll be interesting to see, which way the prices adjust. On the OZ side, I'm obviously, keeping an eye on the some of the legislation coming in place now, the tax extenders, and the OZ Transparency Act, which I think we're not going to hear anything about that for a while. But I mean, that would be another heads you win, tails you don't lose. If you're going to invest in an OZ fund and you're able to do it on December 31 of this year versus January 1 of next year, all else equal, you choose December 31 of this year, because if that bill does go through, then you would get the 10% step up in cost basis,
Yep.
assuming it's written the way it's written now. Yeah, those are kind of the things that I'm looking at.
That's great, Clint. Well, again, it's been a pleasure speaking with you today. Pleasure as always to see you and continue to work with you and your Nest Opportunity Fund. If anyone in our audience of high net worth investors, advisors, family offices, they're interested in learning more about you, your approach, and your Opportunity Zone Fund at Nest, where can they go to learn more?
Yeah, you can just reach out to me. My email is clint@nestopportunityfund.com, or call the office at 614-469-4685. And if I don't return the email, which sometimes I get, a little bit behind, shoot me a text, 614-905-6233. But any sort of year-end type tax planning doesn't happen the last week of the year. Just while I give my contact information out, just whenever I know that.
That's true. Yeah, hopefully that's better done a little bit earlier in the year than the last week of the year. Last week of the year can be a little bit hectic.
Today is
For
not early.
What's that?
Today is not early.
Today is not early. That's true. And we're recording this the first week of December, so it's only going to get busier, I'm sure. For our listeners out there, I will have show notes for today's episode available on our website as always, opportunitydb.com/podcast. There you can go to find all of the resources that Clint and I discussed on today's show. And please be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. Clint, again, it's been a pleasure. Thanks so much for joining me today.
Hey, thanks for having me, Jimmy. It was fun.